A near record low percentage of home sales are foreclosures. What does that mean? Hey, it's David Hittle with United Real Estate Louisville. I want to talk about something you might be seeing in the headlines on the news: foreclosures, and more specifically, how few home sales are foreclosures right now. It's a near record low percentage. And that fact has a lot of implications for buyers, sellers, and the housing market in general. So let's unpack what's going on, why foreclosure sales are so low, and what that means where we live. First off, what does the data tell us? According to ATTOM's July 2025 foreclosure market, there were about 36,000 properties in the U.S. with foreclosure filings. That number was up year over year about 13% and 11% for starts. But even with that increase, foreclosures still represent a tiny fraction of all home sales and all housing units. For example, ATTOM reports that 1 in every 3,939 housing units had a foreclosure filing in July of 2025. That is very low in percentage terms. Another recent source says that in the first half of 2025, only about 0.13% of homes nationwide had a foreclosure filing. In other words, fewer than 1 in 750 homes. So why foreclosure homes are such a small share of sales? Well, there are several reasons that are contributing to why such a low share of sales are foreclosures. The first major reason: high homeowner equity and strong home value gains in recent years. Many homeowners who might be financially stretched still have enough equity in their home to avoid foreclosure or to negotiate with their lenders. Second major reason is new forbearance programs, loss mitigation programs, and more lender flexibility. Especially after the pandemic, many lenders and loan programs now have tools that allow payment relief rather than immediate default. The third reason is stricter lending standards. Loans today tend to require more credit documentation, more proofs of income, and so that narrows out and removes risky loans that might default quickly. Another reason: economic stimulus and relief efforts that have helped many people stay current or avoid falling too far behind. All of that means that even though distress is rising in some areas, it's not showing up in a flood of foreclosure sales in most markets. So, what does this mean for the different players in real estate? For buyers, the low percentage of foreclosure sales means you cannot expect a lot of bargain inventory from the foreclosure category. Some people assume foreclosures are the main path to deals. Right now, they just aren't. But lower foreclosure sales also mean less competition for distressed sales, which can stabilize values and reduce the variance in what homes are actually worth. For sellers, having fewer foreclosures in the mix tends to help resale values. Homes are not being undercut broadly by bank repossessions or deep discount sales. You will still need to compete well, but you are less likely to be compared directly to a foreclosure priced home if those are rare in your area. For the market, it suggests relative stability. Fewer distressed sellers means less downward pressure on prices in many areas. However, in certain markets or price bands, foreclosures could rise later if economic conditions worsen. So this low rate does not eliminate risk. So what do you need to know going forward? And what should you keep your eye on? Foreclosure starts versus completions. Seeing more filings is one thing. Seeing a lot of foreclosures finalized is another. And that has more impact on prices and inventory. State and local differences exist as well. Some states have much higher foreclosure activity than others. If you live or invest in areas where foreclosures are rising, that neighborhood may behave differently. Economic stress indicators such as job losses, inflation, rising insurance or tax costs, plus rate increases, if those things get worse, more homeowners might find themselves unable to catch up. Another factor is mortgage rate trends. Rising rates increase monthly payments and can stress homeowners who are already stretched. So here's what I want you to walk away having understood. The idea that foreclosures are driving bargains right now is mostly a myth. Foreclosures make up only a very small slice of home sales, which means your deal strategy should assume most homes are normal sales and not distressed. If you like, I can pull up the foreclosure shared data here in Louisville or Jefferson County and tell you how many homes are selling as foreclosures, how that compares to the national average, and whether your price tier is likely to see any risk. My name is David Hittle. I'm with United Real Estate Louisville. And remember that stability may be the headline, but insight comes from the data.